Legendary investor Jeremy Grantham is calling for a 70% stock market crash. This is a massive, massive claim. He's claiming that this is the most expensive market in American history, a crash closer to 70% versus 50%. I mean, that sounds like a lot of confidence to me. And he's mainly blaming it that, since 2010, we had a PE above the average, 60% above the average. So he believes the PE will get back to its historical average of about 16 times. And I hear such claims from many other people. I don't personally agree with them. I'm going to tell you why in this video, explain the market's overvaluation, why it looks overvalued, and if it's actually overvalued or not, and my overall view on those predictions. So I really hope you enjoy it as always. Now, if we look at the PE ratio, yes, I agree that 20 times earnings sounds expensive on a historical average. We used to trade at an average of 16 times, sometimes even at 14, 13, sometimes even at 10 times earnings. If you look at other markets in China and other places, they're trading at 7, 8, 9 PE. We're trading at 20 times earnings in the United States. That looks like a bubble. But there's two things we have to keep in mind. The first one is the profit margin expansion. So most of the index right now is dominated by a lot of tech companies. The tech companies have much higher profit margins than industrial companies and oil companies that we had back in the 90s, even before the 90s in general. So if we look at the profit margins, they have expanded from about 9% in 2004 to almost 16%. This is a massive, massive expansion. So before we claim that just because we're above the average, that means we're overvalued, we have to ask why. Maybe because profit margins are much, much higher. Maybe because we have much better companies dominating the market. And maybe because we're growing so rapidly. If you look at the PEG ratio or the price to earnings growth, it's trading at 0.8, which means the PE ratio of 20 is trading below the average earnings growth, which is more than 20% on the S&P 500. I don't know about you, but a combination of more growth, of better margins in general, should naturally lead to a higher multiple relative to its historical average. So if we had the same growth, the same profit margin, same of everything, we can say, yes, this is a bubble and we're going to get back to the average or to the mean. But that's definitely not the case, because we would be comparing apples and oranges, and that's not the best comparison. Now, the second thing you have to look into is the S&P 500, which is trading at about almost 7,300. Now, if we go down 70%, like Jeremy Grantham is expecting, we would go back to about 2,200, which is pretty much the COVID lows. That would be a major, major crash. And you should ask yourself, how likely is that to happen whenever 62% of people in the United States are invested in stocks? Whenever you have the Trump accounts and a lot of kids invested in stocks, when you have retirees, their 401ks and their retirement depends on those stocks much more than it depends on Social Security. And when the market is so big and when so many people are involved so much that it's dictating elections, it's dictating the economy, it's pretty much dictating everything, which is why this administration is so obsessed with the stock market, because they're smart enough to know that it pretty much shapes up the sentiment, it shapes up the elections, it shapes up everything. So how likely is it for the market to go down 70%? I'm personally not seeing it. Maybe outside of, hopefully, we never have some kind of a nuclear event or something crazy, or maybe it's something with Taiwan or whatever. But I'm not seeing how we go down 70%. I'm just not seeing it. I would even bet that the government itself would start buying stocks to support the markets, just like they support the bond market, if we ever go down 50, 60, or even 70%. But how likely, again, is it to happen whenever you have the government's 10% of individual income tax revenue coming from capital gains, coming from people taking profits on their stocks? What happens if we have a 3 or 5 year bear market? Then the government would lose, again, a massive chunk of the revenues, maybe 10%, maybe a little bit more. So the government's revenue is also dependent on the market. So if you really look at the difference between now and then, when before we had like 30, 32% of the population invested in the market, now we have 62%, not accounting for the Trump accounts and so many different people that are now now, actively or passively investing in the S&P 500 and the index in general, I think a 70% crash is unlikely to happen. Now, I'm not really arguing with the fact that he's a very smart investor and I learned a lot of things from him. And he did warn about margin debt, which margin debt has been increasing at a very rapid pace, has increased 53% year over year. Generally speaking, when margin debt increases about 60%, it tends to mark a major top. We had it in 2021, we had it before 2008, and we even had it around 1999 to 2000, whenever we had the dot-com peak, as investors were taking on margin, taking on leverage to speculate on stocks. Now it has increased 53% year on year. It's getting close to 60%. And, that sounds like there's a lot of speculation. He also highlighted the SpaceX stocks that it could potentially be marking the top, just like when Microsoft did, and it fell 70%. And he believes SpaceX could fall 70 or 90% like Microsoft and Amazon in 1999. I'm not saying a 70 or 90% pullback, but I did say that SpaceX to me is expensive and my fair value on the stock is about $70, which is about 50% less than where it is today. The average IPO goes down 50%, so I would not be surprised if we ever see it on SpaceX in general. So I'm not downplaying the fact that the market is a little bit expensive, that we have a little bit of euphoria going on, but I'm not seeing any major bubble territory or a potential 70% stock market crash. And what makes this market much trickier than any other market is the massive divergence between the hyperscalers, or mainly the Magnificent Seven stocks like Google, Amazon, Microsoft, Meta. All of them are down double digits. You have investors like Bill Ackman, which is invested in all the quality stocks and the big seven. He's down like 25% year to date, while the S&P is up about 7.5%. So there's a massive divergence between the two. And the question is, what happens once those big tech stocks start to maintain capex or maybe start to reduce capex? What would happen in this case? The memory and the semiconductors would likely go down, but then would the other stocks also go down? Or we would have a rotation from the semis back into the hyperscalers, they equal each other, and we have a crash within the market, but the overall S&P doesn't go down because we have a rebalancing. So this is why this is so tricky. Like if everything was going up together like it was in 1999, like it was in 2021, and I was in 2021, and I call it a bubble, it was an easy call. But now you don't really have that because you have such a divergence that you ask yourself, what if we hit somewhere close to peak capex this year or next year with a lot of the hyperscalers free cash flow nearing zero? Their balance sheet is loaded with debt to bet on capex, and they're even issuing stocks like Google to bet on capex. So where are they going to get even more money to bet on capex? So if we're likely near some kind of a peak in capex growth and they maintain capex, what's going to happen to the semiconductors? And what's going to happen to those stocks, and how does it affect the S&P? And the truth is, I don't know. So this is why this is so hard to call or predict. But again, based on the overall health of the market, I am not seeing a 70% crash or 50% crash unless something systemic happens or a war or something. But worst case, I see tiny pullbacks here and there until we get more clarity around, mainly what's going to happen with the whole AI spending stuff, the memory stuff, which is getting out of hand, and what the Fed is going to do. I don't think they're going to hike 3 times. I think they will hike 1 time maximum, and the market should recover. But that's my opinion on Jeremy Grantham's call of a 70% stock market crash. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.